Where does mortgage money come from? What does your mortgage payment or rent check have to do with the global economy? And how does Freddie Mac figure into it? Let's find out. The U.S. Congress created a secondary mortgage market in the 1930s to give lenders a much bigger, steadier, and more evenly distributed stream of mortgage money, other than bank deposits, and in turn, to make homeownership more affordable for the average household. The secondary mortgage market connects lenders, homebuyers, and investors all in a single efficient system. This keeps mortgage rates lower, allows for fixed-rate mortgage terms of up to 30 years, and puts homeownership in reach for more households. Freddie Mac was chartered by the U.S. Congress in 1970 to support America's secondary mortgage market and keep money flowing through the system in good economic times and bad. Where does mortgage money come from? Let's say you're ready to buy a home, so you contact a lender for a loan. If you meet the lender's requirements, they approve your mortgage loan application. Once you buy your home, your lender can either hold the loan on its books or sell it in the secondary mortgage market. By selling your loan, and let's say Freddie Mac buys it, your lender replenishes its supply of mortgage funds, allowing it to make loans to more borrowers. It also relieves the lender's risk related to holding the loan. What does your mortgage or rent check have to do with the global economy? What is Freddie Mac's role in making the connections? Freddie Mac pools the mortgages it buys, bundling similar types. It then sells shares of the pool to investors from around the world, such as pension funds, mutual funds, insurance companies, and banks, including foreign central banks. Investors are willing to buy these shares because Freddie Mac guarantees that they'll receive a steady stream of income over the life of the mortgages in the pool, based on the principal amount and interest calculated on the mortgages. What does your monthly mortgage payment or rent check have to do with all of this? When you make your mortgage payment each month, the bank that manages your loan, known as the servicer, sends the payment to Freddie Mac, which, in this example, owns your loan. The servicer keeps a small portion of your payment for managing your mortgage. Freddie Mac bundles your payment with other mortgage payments and sends them on to investors. If you're a renter, your monthly rent check probably helps pay the mortgage on the property and works its way through the system in a similar fashion. Where does Freddie Mac get the money to buy mortgage loans? Freddie Mac generates money to buy mortgages and finance rental housing in several ways. It charges management and guarantee fees for accepting and managing the risks associated with the mortgages it buys. It also sells bonds to investors around the world. The secondary mortgage market is a continuous cycle involving trillions of dollars moving around the world, from global investors to local lenders to borrowers across the country and back again. Freddie Mac helps make this possible. America's homebuyers benefit from a strong secondary mortgage market in several ways. Mortgage loans are more readily available to qualified borrowers. Interest rates for mortgage loans are similar across the nation in good times and bad. Mortgage loans with longer terms, such as 15 or 30-year mortgages, are available, and they're the most commonly used. And borrowers can refinance or pay off their single-family home loans at any time without penalty in most cases. Freddie Mac continues to provide a stable, consistent source of mortgage funding and to support the U.S. housing market recovery.